Overcoming trading losses is not a technical problem to be solved. It is a psychological passage to be crossed, and most traders underestimate how deeply losses reach beneath the surface of strategy and execution. Losses do not simply reduce capital. They test identity confidence and the fragile belief that effort should be rewarded quickly. Trading literature written by those who endured long careers makes this clear in quiet tones. Losses are not interruptions to the journey, they are the terrain itself. How a trader responds after losing is far more important than the loss itself, because it reveals whether trading remains an emotional gamble or begins to mature into a disciplined craft. The first challenge after a loss is emotional residue. Losses linger in the nervous system even after the trade is closed. They show up as hesitation on the next setup aggression to make it back, or a subtle tightening of focus that distorts perception. Many traders rush past this stage, believing they can think their way out of an emotional state. Yet the literature on trading psychology consistently warns that unprocessed losses do not disappear. They express themselves through behavior. Bouncing back begins with acknowledging that something has been shaken, not just financially, but internally. One of the most important lessons losses teach is the difference between being wrong and being undisciplined. A loss taken according to plan is fundamentally different from a loss created by impulsive behavior, yet beginners often experience them the same way emotionally. This confusion slows recovery. Profitable traders learn to separate outcome from execution quickly. They ask a simple but powerful question: did I follow my rules? If the answer is yes, the loss requires no fixing, only acceptance. If the answer is no, the loss becomes information about behavior, not proof of inadequacy. This distinction is the foundation of resilience. Another early mistake traders make after losses is rushing to trade again. The desire to recover emotionally often disguises itself as motivation. Trading literature is clear on this point. Revenge trading is rarely loud at first. It often appears as slightly larger size, slightly lower standards, or slightly faster entries. These small deviations compound. Bouncing back stronger means slowing down deliberately when the impulse is to speed up. Stepping away, even briefly, allows the nervous system to reset and prevents one loss from cascading into many. Losses also expose expectations. Many traders discover painfully that they were secretly expecting not to lose. Intellectually, they understood probability, but emotionally, they were unprepared for drawdowns. This gap between theory and experience is where confidence fractures. The traders who recover best are those who recalibrate expectations after losses, aligning them with statistical reality rather than hope. They revisit their system's historical drawdowns, reminding themselves that discomfort does not mean failure. This reframing transforms losses from threats into confirmations that the system is behaving normally. Review plays a central role in bouncing back, but only when done correctly. Immediately after losses, analysis is often contaminated by emotion. Skilled traders allow space before reviewing, returning with a calmer mind. They look for patterns, not blame. Was risk consistent? Were setups valid? Was execution clean? The goal is not to eliminate loss, but to ensure loss remains contained and meaningful. This kind of review restores agency. It replaces helplessness with clarity. Another crucial step in recovery is restoring process confidence before risking full size again. Many professional traders reduce position size after a losing streak, not because the strategy stopped working, but because confidence needs rebuilding. Smaller size lowers emotional stakes, allowing execution to stabilize. This gradual re-engagement prevents fear from hardening into avoidance or aggression. Bouncing back stronger is rarely about dramatic comeback trades. It is about quietly regaining rhythm. Losses also offer an opportunity to strengthen discipline beyond the charts. They invite reflection on sleep, stress, focus, and external pressures. Trading literature increasingly emphasizes that losses cluster not just around market conditions, but around personal states. Fatigue, distraction, and unresolved stress amplify drawdowns. Traders who use losses as prompts to audit their broader routine often emerge stronger, not because markets change, but because they do. Perhaps the most important shift losses force is humility. Losses remind traders that control is limited and certainty is an illusion. This humility, when embraced rather than resisted, deepens patience and selectivity. Traders who bounce back stronger do not become more aggressive. They become more precise. They trade less, wait more, and protect capital with renewed seriousness. Confidence returns not as bravado, but as quiet trust in process. Ultimately, overcoming trading losses is about integration, not erasure. Losses cannot be avoided, but they can be absorbed, understood, and used. They test whether a trader is outcome-driven or process-driven, whether discipline is conditional or durable. And it is right here in the aftermath of loss, when emotion is loud and clarity feels distant, that the real work of resilience begins, because this moment determines whether losses become scars that limit future decisions or lessons that quietly strengthen the foundation beneath them. And this choice, repeated over time, is what separates traders who merely survive drawdowns from those who emerge steadier, calmer, and more aligned with the long game they chose to play, because recovery is not a moment of motivation. It is a sequence of small, disciplined choices made while confidence is still fragile. Trading literature often emphasizes that the most dangerous period is not the loss itself, but the days immediately after, when emotion quietly seeks resolution through action. Bouncing back stronger requires resisting this impulse and choosing stabilization over redemption. This choice rarely feels satisfying in the moment, yet it is the one that preserves long-term viability. As recovery unfolds, one of the first priorities is restoring internal safety. Losses disrupt the sense of control that traders rely on to execute calmly. To rebuild this, experienced traders return to basics. They trade smaller, follow rules more strictly than ever, and limit exposure. This is not regression, it is recalibration. Smaller risk creates space for confidence to rebuild organically through correct execution rather than forced success. Each well-executed trade, regardless of outcome, becomes evidence that discipline remains intact. Another important aspect of bouncing back is learning to forgive mistakes without forgetting them. Harsh self-judgment after losses drains mental energy and narrows focus. At the same time, ignoring mistakes invites repetition. Trading psychology literature often frames this balance as compassionate accountability. The trader acknowledges error, extracts the lesson, and moves forward without carrying emotional debt. This emotional hygiene prevents losses from contaminating future decisions. Recovery also benefits from redefining success in the short term. After a drawdown, success is not measured in profits, but in behavior. Did you stop when you said you would? Did you pass on marginal setups? Did you respect risk limits, even when tempted? These behavioral wins rebuild trust faster than any single profitable trade. Over time, this trust stabilizes emotions and restores clarity, allowing size and frequency to normalize gradually. Another powerful recovery tool is perspective. Losses feel personal when viewed too closely. Zooming out to review long-term performance helps contextualize drawdowns within a broader distribution of outcomes. Many traders keep equity curves or statistics precisely for this reason. Seeing that losses fit within historical norms reduces emotional intensity and prevents overreaction. Perspective transforms loss from crisis into data. There is also a social dimension to recovery that is often overlooked. Isolation after losses amplifies rumination. Traders who have access to mentors, peers, or communities grounded in process rather than hype recover faster. Conversation externalizes emotion and normalizes struggle. Trading literature often highlights the role of shared experience in building resilience, reminding traders that losses are universal and survivable. As confidence returns, patience deepens. Traders who recover well often find themselves trading less, but with greater intention. They wait for cleaner conditions, avoid forcing participation, and protect their regained equilibrium. This restraint is not fear, it is respect for the work required to rebuild. Over time, this respect becomes a protective habit, reducing the severity of future drawdowns. The final transformation in overcoming losses is the integration of humility. Losses remind traders that certainty is unavailable and control is partial. Accepting this truth reduces emotional volatility. The trader stops needing the next trade to validate them and starts allowing outcomes to unfold within a trusted framework. This humility does not weaken ambition, it refines it. It shifts focus from proving something to sustaining something. In the end, bouncing back stronger from trading losses means emerging with greater self-awareness, tighter discipline, and a calmer relationship with uncertainty. Losses become checkpoints rather than endpoints, moments that test alignment between intention and behavior. Traders who pass these tests do not do so through willpower alone, but through systems designed to protect clarity when emotion is loud. And it is through this repeated process of losing, recovering, and refining that a trader slowly develops the resilience required for longevity. Learning not to fear losses, but to trust their ability to navigate them without losing themselves in the process. If this reflection on recovering from losses resonates with your experience, consider subscribing to continue exploring the deeper psychological mechanics of consistent trading, and leave a comment sharing one practice that has helped you regain balance after a difficult drawdown.